Hi, it's Kiffin Lebates here, and some of you may be watching with amazement and horror what is happening in the cryptocurrency world these days, specifically in relation to Binance and FTX. FTX is a exchange that appeared around 2019, looked to be doing very well, and now it's all gone south. And what I'm going to do in this video is not explain the details between the machinations of Binance and FTX, but rather look at a model of how a company can use tokens in the crypto world to give the appearance of being immensely successful whilst actually building their business on a foundation of sand. So this is just hypothetical. Don't want anybody coming back to me and saying, well, that's not exactly what happened with FTX, and by the way, the lawsuit is in the mail. I'm just giving an example of the kind of things that you can do with tokenomics that are completely unethical, but because it's an unregulated space, you might well get away with for a while. So imagine this: you have a fair amount of capital, but what you want is to get your hands on a lot more capital in order to be able to build a bigger, faster business. And so what you do is you issue 100 million tokens, say. Now, you keep 95 million of those for yourself and you distribute them amongst a number of shell companies. The other 5 million you put into the marketplace and you build a market for them. So there's 5 million tokens out there. Maybe they start off at $1 a piece, but you start buying and selling some of those tokens on the various marketplaces in order to drive the price up. This is called wash trading, and you spend money on marketing in order to get the public interested in owning some of these tokens themselves. Now imagine that after a while these tokens, these 5 million, are trading at say $10 or $12 a piece. That means that the remaining 95 million that you own in your shell companies will have a total value on paper of around $1 billion. Now that's not much use to you because you can't sell them, because that would drive the price right down, it would crash it, and you'd end up with nothing. But what you can do is you can use those shares, as they effectively are, or those tokens, to raise funds, to get a loan, with the tokens acting as collateral to back your loan. Now clearly the cryptocurrency space is an unstable one, and no lender is going to lend you anywhere near the sum of $1 billion that those tokens are worth on paper, but you might be able to raise, say, $250 million, because lenders are faced with a problem. They've got a spectrum of risk versus returns. If they don't take any risks, they don't lend, they don't get interest, they don't make any returns. If they take too high a risk, they lend and then lose the money that they lent due to bankruptcy or due to some other unforeseen problem. And when you look at the crypto space, it's an unreliable space, but you might well be able to get a quarter of the paper value of the tokens as a loan at some reasonable rate, probably higher than the conventional markets, but nothing astronomical. So now our token issuer has $250 million in the bank, and that's a good sum of money to be able to start building a very plausible looking business. You can start investing, you can start acquiring other companies, you can start undertaking activities that make you look like a serious player in the space. But what's the problem here? Well, if something goes wrong, if there's a shock event that drives the value of the token down, then the lender is going to want to call in their money. And you won't be able to repay it because you've got it spread out among all sorts of schemes and activities, and your company will fold to the detriment of all the people around who put money into those initially released 5 million tokens. Now, if you're a clever but unethical person, then you will have extracted some of the value in the form of salary and assets and things like that you've moved from the company to your own personal name as compensation for the amazing work that you're doing. And even though your company collapses, or your collection of companies collapse, the fact is you'll still walk away from it personally very well off, to the detriment of the lender and the general public. Now, as I said, I'm not saying that this is exactly what happened here, but these are the kind of tokenomic schemes that you can see in the cryptocurrency space. And one of the reasons for that is because regulation in the crypto space is lax compared to that in the traditional financial world. Although even the traditional financial world still on a monotonously regular basis sees schemes like this also going into effect and people getting ripped off. The thing is that the authorities are more aware of how they work, and they are generally speaking quicker to respond in order to clamp down on them. The main reason being to keep confidence in the markets. It's not really about keeping the individual personal investor safe. It's about keeping the whole system stable and running. But anyway, my cynical observation there aside, that's an example of a scheme that can be used in order to defraud people in the crypto space. Now, if you found that interesting, I did recently publish a book under a pseudonym. It's called Evil Tokenomics by Maximilian Sauron. It's only 80 pages long, so it's only a couple of hours worth of reading time, but I have priced it very competitively at $7.50 for the paperback, or under $5 for the Kindle version. So you might want to check that out, because it's got lots of examples of other schemes like this that can be used in the token space to extract value from the naive. And I've written it in under a pseudonym because the story is presented as though it's been written by well, let's face it, an evil participant in the crypto space, thinking from their mindset, because I think that's a good way of teaching what the issues here are whilst producing a reasonably compelling story. So hope you found this video interesting. Do hope that you go and get a copy of the book, because I would like to sell a few more of them, and in the process hopefully educate more people as to the kind of things that can go wrong out in the crypto space. And the thing that remains for me is to say, be safe, do your research, remember the key things, such as if a deal looks too good to be true, then it probably isn't true. And I hope to see you all in the next video soon. Bye for now.